Now that we've wrapped up measuring, let's continue with some other seller discussions, like CMAs and calculating net to seller. So let's just scratch the surface. I'm not going to go full-fledged, but we're going to scratch the surface on the next big topic of conversation, and that is a CMA, okay, comparative market analysis. And that is, of course, a very important aspect of being a listing agent. And as I'll remind you, we're talking about the working with residential and commercial sellers section as we currently sit. And so CMA is a big piece. Now, let me go ahead and just start kind of rambling as I like to do because I've taught this so many times. A CMA stands for a comparative market analysis. Well, we also talk about BPOs, which stands for broker price opinion. Now, if you were to look in the North Carolina Real Estate Manual, this purple book that we talked about on day one, they have the exact same legal definition, folks. A BPO and a CMA are the exact same thing. A lot of students don't realize that because we typically refer to them in different contexts. A CMA, comparative market analysis, is what we typically call it when we are doing it for a client. And you need to be doing a CMA for both a seller and a buyer. Folks, why would you need to do a CMA for a buyer?
To make sure they're not overpaying for the house, that it's priced properly.
There you go. Remember when we talked about our fiduciary duties? Isn't it a lawful instruction to overprice a house? Yeah. And so as such, isn't there a good chance that if we're buyer's agents, we say, well, list price is a list price, just pay it. Then we are not doing our job right because it could be priced so terribly wrong, which means we could have appraisal issues, which means our clients could lose their due diligence, which means they could be overpaying even if there's not appraisal issues. And so both listing agents and buyer's agents should be doing CMAs. So I'll say it again. We call them CMAs when we're doing them for a buyer client or a seller client as part of our job. The context in which we typically refer to them as BPOs, which is a broker price opinion, is when we are doing them for a third party for a fee. The most common time that happens is the bank. Now, understand a couple things, okay? Back in the day, and I want you to picture like 2007, 2008, 2009, when we had the housing market crisis. There was a lot of people upside down on their mortgages. There was a lot of foreclosures. And so what the banks would do is they would pick up the phone and they'd call real estate agents. And folks, there was a lot of them, and they were all twiddling their thumbs. Okay, the market was not doing well back in 2007, 2008, 2009. And so they'd pick up the phone, they'd call real estate agents, they say, hey, I'll give you $150 if you go out and do a broker price opinion for me on 123 Main Street. Tell me what you think we could sell it for. Same thing, right? What is a probable sales price? What is a probable list price? And the broker would go out and do it. They'd do this BPO and they'd take it back to the bank. The bank would pay them $150. Now, of course, the agents were like, well, why'd you need that? And the banks would be like, mind your business, okay? And so what they were doing is they were trying to figure out if it was worth foreclosing on this property or not. What could it sell for? Should we try to work with these homeowners on a loan modification so they stay there? Or should we foreclose and try to get the money? Can we sell it for enough that it'd be worth it? And there was a lot more real estate agents, and they were cheaper than appraisers at the time. So it was a very common practice. It still exists today. There are still bank-owned properties. There are still foreclosed properties. There's still short sales. And so BPOs for a fee still exist. Now, please understand that even though one is for a client, the CMA, and the BPO is for a customer, because you're getting paid, you still have to do it with competence. It's not, I had one student tell me one time, oh, the difference is the CMA, you actually pull the numbers, and a BPO is a guess. No. They have to be done with the same level of expertise and the same level of integrity, no matter if it's done for a fee for a third party or for a client. Okay? Doesn't matter. Now, the other piece of clarity, you fine folks cannot do a BPO for a fee right now. Okay, provisional brokers are not allowed to do a BPO for a fee. Full brokers big eligible brokers sure can. But a provisional broker cannot do a BPO for a fee, but absolutely you can do a CMA for a client, and you better do it in a competent manner. Everybody good on that? So we are expected to be able to perform these CMAs or BPOs in a competent manner. And of course, they are helping us determine probable sales price, probable purchase price, probable list price, whatever you want to call it. And I will tell you, in our update last year, we had a very big discussion on clarifying that we as real estate professionals cannot use the term value or worth. Only a licensed appraiser can use those terms. Now, of course, we break that rule a lot because we are always sending out those mailers, find out what your home is worth and find out the value of your home today on my website. And the commission's starting to say that's not a good idea. So remember, we should be only talking about probable sales price or probable list price, never worth or never value. And I'll never forget it. I taught this in a class one time, and I said exactly that. And I had a student, I don't remember who it was, but bless her heart, she was so cute. She said, well, it says we're not allowed to use those words. What if I'm trying to tell them what my value is and what my worth is if they hire me as an agent? I say, oh, bless your heart, sweetness. No, you can use those words about you. You just can't use those words about houses, right? You can't talk about what a house is worth. You can talk about your worth and your value as their agent, but don't talk about what their house is worth, even though that's what sellers want to know, isn't it? They say, well, Mr. and Mrs. Real Estate Agent, tell me what my house is worth. Tell me what I could, tell me what the value is. We're going to answer them, but we're not going to call it that. So, of course, if you think back to pre-licensing, when we talked about real property valuations, we all remember there is some differentiation between pricing a property that is a residential resale home or even new construction versus a commercial income producing property versus a very unique piece of property like a hospital, a school, or things. And so if you remember the three big approaches, there was the sales comparison approach, there was the income capitalization approach, and then there was the cost approach to valuations. I would argue that cost approach, in my opinion, is outside of the scope of any real estate agent. No real estate agent should be attempting the cost approach. Income capitalization approach, absolutely. Sales comparison approach, absolutely. And we're going to talk about those. So let's keep going with these discussions. Of course, we have to be able to do these things in a competent manner. And we're going to talk about what a competent manner means. Now, I'm going to give you a word of warning right here, right now, folks. You're going to realize that there is a huge difference between the textbook version of a CMA and the real world version of a CMA. And you'll find out what I mean very shortly. And you'll realize it makes a lot of sense. But folks, think about it. Do you think textbook open heart surgery is the same as actual open heart surgery? I don't want anybody doing open heart surgery on me that's just read a book, okay? Like, I need you to have some real world experience. I need you to have watched over somebody's shoulder. And there's, of course, some things that come into play that you can't account for in a textbook world. And I'll give you an example of that in just a second. Well, let's clarify some of this language that I'm using, okay? I told you value. When we say value, more specifically market value, that is the appraisal process. An appraiser comes out, they look at your property, and they determine a market value. And so what they say is, what do we as appraisers think that this would sell for in an open and competitive market with competent parties? And so they call that market value. Well, folks, let me explain the difference between market value and market price. Market price is what it actually sold for. So I want you to picture this. If I hired an appraiser right now to come appraise my property, and he says, well, Seth, your house is worth about $495. I say, cool. That would be my market value as determined by a licensed real estate appraiser. But let's say Tom Cruise, for whatever reason, decides he needs to live in Willow Springs, North Carolina, and he wants my house to level and park his cars in it or something, okay? And so Tom Cruise comes up and knocks on my door and offers me $1 million for my house. Well, folks, you best believe I'm about to sell this son of a gun for $1 million. I'm going to let him keep all the furniture. He can have the dog. He can have the cats. Okay, I guess I'll keep the kids. I like them sometimes. But he can have everything else in the house. It's his if he wants it, right? And if I sell my house for $1 million, we can all agree that the market price of my house that day, that time, was $1 million. Folks, does that make my house worth $1 million? No. Just because some yutz with too much money to his name paid me $1 million does not mean that my house is worth $1 million. And that would be what we call an outlier too. Is that going to be a reasonable comparable for every other house in the neighborhood? No. That is a special circumstance. If you ever pull that comp and you see in the MLS, oh, Tom Cruise bought it for funsies. throw it out. That is not a good comparable property, okay? We're looking for arm's length transactions, and we're going to get into that. Now, let me ask another question. Do any of you in here, well, let me start with the first one, then I'll amend it. Have any of you ever purchased and installed at your property an in-ground pool? Caroline, you have? How much did it cost you, if you don't mind me asking?
A lot more than we realized it was going to be.
Oh, good.
'Cause it's not just the pool.
And there's a lot to it.
Everything around it.
Uh-huh. How much did it cost you? Just sheer curiosity. And you can ballpark it.
Okay, 110.
$110,000. There you go. Oh, this is a perfect example, Caroline. Sometimes I have somebody in my class, sometimes I don't. Caroline, here's the $1 million question. No pun intended. Paying 110 for a pool. Here's the $1 million question. Caroline, did adding that pool add $110,000 worth of value to your property?
No.
No. Nope. Sure didn't. And Caroline realizes that as a real estate professional and as a homeowner, which makes her, a very unique homeowner. And that's what we call market cost, folks. That pool cost Caroline $110,000. So that was her investment for that pool. I don't know to what extent, because 110 sounds a little bougie. Okay, so maybe it adds a little more than.
It has a spa. It's a complete,
Is it where you live now?
spa. It's heated. Pardon me?
Is it where you live now?
Yes.
Okay, yeah. Very nice. Yeah, I bet it is a little bougie. The average in-ground pool that's very modest, I would say, is about 80. So 110 is probably, once again, a very nice kind of setup. But even as nice as it probably is, Caroline, let's just be honest with ourselves. You'd be lucky if it adds 40 to 45. Even in that ballpark would be a huge benefit to you. Now, if you find the right buyer, it could be more than that. But as a generalization, the correlation is not dollar for dollar. You will never have an investment that's dollar for dollar. And so that is the difference between market cost and market value, market price. And so you know what we say whenever we meet a seller, like Caroline very much knows this. And so whenever you meet a seller, they always think, oh, well, I paid 110 for my pool, so I can just add that value back in. You know what you have to say to them, right? You say, well, did you enjoy that pool? Have you enjoyed it? And they say, yeah. You say, well, that was your value right there, okay? Your enjoyment is the money that you spent. Because just because you were willing to spend $110,000 on a pool does not mean the rest of the world is willing to give you that 110 back, because it may not have had that same value to them. So, yeah. Love that. Folks, the same is true of garages, okay? I would say that a big 2-car garage with a loft right now, $60,000 to $80,000. Now, that's a bigger return. You're going to see a lot more money back on a garage because people find a lot of utility and use out of those. But even that, you're looking to get $35,000 out of a 2-car detached garage, even though it costs you $60,000 to $80,000. And so it's very important when we're having these discussions with sellers, when they pull out a sheet and they say, well, I spent this on this, I did a kitchen remodel, I did this, I did that. Great. We're not allowed to just slap that into a list and say, okay, let's get all this money back. It doesn't work that way. And so market value, what the appraiser says the property is worth. Market price is what it actually sold for, and market cost is the investment by the owner. Now, market cost could be the features, as I said. It could be what the house cost you when you first bought it, which at the time would have been the market price. But, of course, you're selling it for a different amount down the road. So I'm going to tell you something before we even get into the BPOs and the CMAs in great detail, folks. I want you to remember, when you are working with buyers and sellers, what type of agent did we say you are? What level of authority do you have?
Special agents?
Yeah, yep. And I saw a couple of you say special agents, right? And so who ultimately makes the decisions?
The client?
The clients, right? Yeah. The buyers, the sellers. Now, here's where I'm going to make a very strong and important statement. And of course, as we rehash these, as we go forward in the class, talking about CMAs and BPOs, I want you to remember this, folks. Even when you get exceptionally good at CMAs and BPOs, there is this understanding where you realize that the sellers and the buyers make the ultimate decisions. And so I'll give you a real world example of this because we're talking about pools. I sold a house with a pool in Garner in a very modest, moderate neighborhood, cute neighborhood in the center of Garner. more like 4042 area, but Garner address. And it was like an 1,800 square foot ranch, but the people who lived it there, it just had this wow factor. They'd put like bamboo flooring, they'd put really awesome features, really nice, furnishes and trim. And in the backyard, they had an in-ground saltwater pool, and they had this really awesome little pool house that was kind of like Japanese tea house style. And everything about this house just had this wow factor, even though it's just in the center of Garner in a very modest neighborhood. And so at the time, and I'm just wanting to mentally prepare you before we get into the CMA discussions about real world and being realistic to save yourself some trouble. At the time, I did a CMA for those clients, and I could not find, and folks, nowadays, oh my God, it would probably sell for $450,000, but this was 8 years ago. At the time, I don't think I could have justified, based on my CMAs, anything more than 240 in the market at the time that was all I could get for it based on my CMAs. And the client came to me and they said, wow, that's not really low. And I said, I agree with you. Or they said, that's really low. And I said, I agree with you. I said, that's what I can find, but I agree that your house has a wow factor. And so I think we should price it more. So you tell me where you want to price it, and just know that we will potentially see some appraisal issues. We may have some pushback. It may sit on the market. We'll just have to see. But I agree this house does have the wow factor. And this is me telling you the difference between textbook and real world. Textbook CMA, I couldn't justify 280, 290. I think we listed it at like 295 or something like that. I think it was at the time. I suppose it could have been 380, but I'm thinking back then, 8 years ago, it would have been 280 or 290. And so here's the point of the story, folks. Do not ever think that you are the end-all be-all, no matter how good you get on CMAs. And here's what I'll tell you. Over my 9-year career, my numbers for CMAs have consistently come in within $100 to $1,000 of the appraisal. I mean, been very stinking close. Very seldom have I had huge appraisal issues in my whole career. And so I like to say that I'm pretty good at estimating these probable sales prices. And so we listed that home because I couldn't justify it. And I said, let's just go with what your gut says. We listed it at 290 or whatever it was. Excuse me. Thank you. We listed it at 290 or whatever it was at the time. And we got offers in the first weekend, full price, maybe even over, 0 appraisal issues, closed without a hitch. So I'm telling you this so you understand. Don't ever get to the point where you're telling the sellers what they are going to sell it for. You have to understand that your CMA is only one piece of the puzzle. Because while I'm telling you, yeah, just because they invested $80,000 doesn't mean they're going to get $1 for $1 investment. But there are sometimes these wow factors that exist that make these houses more marketable and people can see it. And so the reason I'm telling you this, I was to have listed a price on that house at 230 or 240, whatever I could justify on my CMA, and I'd held my ground and said, that's what we're selling it for. Folks, when they caught wind after it closed that it appraised for 290, you think they're coming for me? Yes. And that is where you have to understand that both under our common law of agency of reasonable skill and care and under license law and commission rules, we have to be able to perform these in a competent manner. And we also have to make sure we never put our foots in our mouths and say, this is what we're selling it for. That's not our decision. We say what we think we could sell it for, what a probable sales price or probable list price is. But of course, there are a lot of different components. So we do have to have the requisite expertise. Anybody can sell a house that's underpriced, but you've got to price it right and sell it to be able to get the maximum benefit for your client and to know that you actually protected them. And so let's just put this in full circle now. We, of course, are going to do our CMA to figure out this probable sales price or list price. Of course, the other things that we take into consideration, the current market conditions. Folks, listing a house right now is very different than listing a house 3 years ago. Of course, the seller's needs, wants, and desires, as I just told you, are critically important. If they think their house is worth more, folks, where's the harm in trying it? You explain we may have to reduce the price. You explain we may have appraisal issues. But you can always lower the price, but you can't raise it. Now, yes, I know there's agents out there that will tell you, well, if you overprice it to begin with, you're hurting yourself in the long run because then you got these pricing reductions and then you got, I say that's malarkey. It depends on the market. In a very competitive market, overpricing it can kill you. In a market more like we're in now, I'd argue that every agent is overpricing it. Why? Because we're anticipating somebody's trying to talk us down. They're going to, because things are sitting longer. So you can always drop the price. Now, I'm not telling anybody how to run their business, but these are all considerations to have with your BIC and for marketing and things of that nature. And of course, the seller's needs, wants, and desires are a big component to this. Of course, as we said before, we need to know the seller's loan payoff. We need to figure out what is the likelihood of us not selling it for enough money. Because if it is that even a listing we want to take on? Folks, when you take on a short sale, we're going to talk about short sales in this section, not today, but in the next session. You can make money on short sales, but buckle up, Buttercup. They are a hot mess express, okay? There are so many different components to them. There is so many hoops you have to jump through. There's so much paperwork. And the name short sale is ironic. They take a very long time. So there is a lot of criteria in deciding what is the probable sales price, what is the probable list price, and ultimately what we're going to list it at. So when we're assisting the seller in setting the price, okay, we do consider what the seller wants to make. Now let me clarify something. A lot of people get confused on this. The seller's net proceeds, that's what they're walking away with after closing. Okay, that's their take home. But that's not the same thing as profit. Can we all agree that if you bought a house for $100,000 and then you turn around and sold that house for $200,000, folks, that's not $200,000 in profit. You got your $100,000 back that you invested into it, but that is $100,000 in profit. You see the difference there? Proceeds and profit are different. So if their house is paid off even and they walk away with $200,000 at closing, it's still not $200,000 in profit. Same thing, if you buy a can of Coke for $1, you sell it for $2, you made $1 in profit because you had to get your return on your investment back plus the money that you made in excess of that. So here's where we're going to get into some more math, okay? And I know we all hate that word. Ew, gross. And I was already so mean to you and made you do some math already with the residential square footage stuff, okay? But here's the thing. I'm going to teach you this math. And I'm going to throw a word into the mix, and you're not going to like it, but I promise I'm going to make it better. Okay, you ready for this? I'm gonna say the word, and you have my permission. If you want, you can throw up in your mouth a little bit. Okay, but then swallow it. Nobody needs to see that. Okay, just a little bit. Here's the word. Algebra. Oh my God! This man just said algebra. Oh! Folks, it's gonna hurt your feelings a little bit, but I promise I'm gonna trick you into accidentally doing algebra. Do you believe me? I am. I've been teaching this long enough. I am going to trick you. Even if you think that is the scariest word ever, I'm going to trick you into accidentally doing algebra. And I'm going to show you why it works, how it works, and why you need to know this. Everybody with me? Nobody panic. Okay, y'all got to trust me on this. I'm not going to hurt your feelings. I promise. So we, of course, have a big consideration when we're dealing with sellers to help them determine what we need to sell the house for. Now, most of the time, folks, we determine what we can sell it for. And then Caroline referenced a net sheet earlier. I'm going to show you a net sheet later. And so a net sheet helps us determine if we sell it for this, if we sell it for this, if we sell it for this, what are we going to walk away with? But sometimes sellers want to know what they would have to sell for in order to net a certain amount of money. Now, that's not how we price houses, but it is still good to know. Because imagine that you go to a listing appointment and they look you in the face and they say, well, I need to net $120,000. If you know how to do this basic math, you can quickly do this calculation and you can look them in the face and say, well, Slick, that means we got to sell your house for $800,000 and it's not worth more than 100. Don't say worth, but we can't sell it for more than 600. And that puts them back in the scope of reality. We don't price houses this way, but this is a good math concept to understand. Now, if we were figuring out the net to the seller, folks, y'all remember credits and debits? You remember those things? Oh, yeah, y'all do. Ugh, still have nightmares, I'm sure, from the credits and debits. But it is a very important thing to understand in your real world as a broker. Why? Because you have closing disclosures when you have a transaction. And you got to help your clients understand their credits, their debits. Now, can we all agree that if we took the total of the seller's credits and we subtracted out the total of the seller's debits, that's going to be their net walk away, their proceeds. So, purchase price is a credit to the seller, minus loan payoff, which is a debit to the seller, minus commissions, which is a debit to the seller, minus all closing costs. Whatever's left is their net pay, what they walk away with. Now, the good news is I'm not going to make you calculate that in this class. That's 302, contracts and closings, when we do credits and debits and closing disclosures and all that. But let's just talk about calculating how much a seller would have to sell for, okay? Let me make your life easy first and foremost. If I was to tell you that we sold a house for $400,000, and then I told you that we were charging the seller 6%. Well, folks, bar none, we know, even if they have no other closing costs, they have to pay us our 6%. You agree? That comes off the top. We get ours first, okay? We're special like that, okay? We get paid first. Now, let me show you something. You could go through the old school calculation method, meaning, okay, well, they're selling for $400,000, and then we're going to take 6% of that. So you could go, okay, well, 400,000 times 6%. So then you're going to subtract out your commission of 24,000. And then if they had no other expenses of the 400,000 they sold for minus the 24,000 in commission we're taking away, can we all agree that if no other expenses needed to be paid, the seller would walk away with 376,000? Everybody cool with that, right? That makes sense? Okay. Well, let's take a step out of this, folks. That's a lot of work. Here's what I want you to think about. If they're selling their property for $400,000 and we're taking 6% off the top, wouldn't it be safe to say that what the seller is really making is 94% of the purchase price? If we take 6% off the top of 100, they're only left with 94%. You agree? Watch how easy this becomes. If now I said, okay, well, if we're taking 6% commission, what's the seller going to walk away with if that's their only expense? Instead of doing what I just did, take your $400,000 and multiply it by your 94%. You see how much easier that was? We've knocked out a whole step, but it makes sense, doesn't it? Now, if you're not familiar with percentages, quick little refresher. Remember, percentages are like pennies, okay? If we say 94%, mathematically it looks like 94 pennies. And if you're not comfortable with that, you can use the calculator. So let me just show you the calculator way. 400,000 times 94, and then you can hit the percent button and it'll convert it for you. Because percentages are based on 100%. So if I was multiplying it, it's a decimal form, 0.94. So here's what happens, okay? If we decided that a seller wanted to net a certain amount of money, I'm going to show you this. Now, it's going to intimidate you for a second. I promise I'm going to make it all better. Trust me. Okay, trust me. Let me show you this. I'm going to skip this slide. So here's what we're talking about. An owner wants to net approximately $70,000 after paying a 6% commission, and the seller's expenses are going to be approximately $400. So what we're asking you is, well, what do we need to sell this property for? Well, folks, we don't know this, but let me tell you the algebraic piece of this. If we look at this and we say, okay, we don't know what it needs to sell for, that's what we're trying to figure out, we'll call that an unknown variable. The most rudimentary form of algebra is all we're doing, where there is an unknown variable and we have to figure out what the value is. Remember algebra, folks? That's when letters got introduced into math, and our world was turned upside down from grade school to that. How dare you put letters in my math? I've never seen this before. You're sick. Okay? But it's not that bad. So let me walk you through this, and I promise I'm still going to make it even better. Can we all agree that since we don't know the purchase price, we're just going to say, okay, well, if we did know the purchase price, 100% of the purchase price minus 6% of the purchase price, which was our commission, minus the $400 in closing costs, needs to equal the $70,000 that they want to net. Does that make sense? Okay. Well, all the most rudimentary form of algebra is if you get everything on one side of the equation except for this unknown variable, then you can figure out the value of this unknown variable. And so think back to it. All you have to do is something on one side and on the other side. So let's just break down the hardest part first, okay? 100% of P minus 6% of P, because if you multiply 100% and 6%, okay, it's like saying 94% of P minus $400 equals 70,000 still. Okay, well, let's get this moved over. Add 400 to this side, add 400 to this side. So now it's negated here. So now 94% of P equals 70,400. And that's multiplication. So if you divide by 94% on this side, divide by 94% on this side, I'm going to go ahead and convert it into a decimal. That means P, the purchase price, equals 70,400 divided by 94%. So let me do the math on that. 70,400 divided by 94%. We would have to sell this property for $74,893. And folks, the beautiful thing about math is you can check your work. Watch. If we're taking 6% off the top, let's say we sold it for this price times the 94% they'd be left with gives them 70,400 minus their closing costs of 400. By God, they are left with netting $70,000. That's algebra. Now, folks, here's where I'm going to make your lives so much easier. Okay? I'm going to trick you into doing algebra right here, right now. You ready? All you have to do to calculate this, when you see this type of question, you take every number that you see that doesn't have to do with commissions. In this case, 70,400, and you add them together. And then you divide by what is left over from 100% after you take your commission. 0.94. And you are accidentally doing algebra. I'm going to show you this. We're going to test this theory. You ready? Let me show you the actual solved version pretty here. If you wanted to use T-bars and do it the old school way. Here's the answer to everything that we just did for example 1. But I'm going to slap example 2 up, and I'm going to reiterate exactly what you need to do. So there's the answer we just got. But here is example 2. Folks, this has more components, but I want you to listen to me, okay? I just told you, add up every number you see that's not commission, and then take that number and divide it by the commission that's left, or the percentage that's left over after you take your commission. Well, first let me help you out. How much commission are we charging on this one? There you go. I see you mouthing it. 5.5%. And so if you take 5.5 from 100%, what percentage is left? There you go. Mouthing it again. 94.5%. Everybody agree with that? So add up every number you see on here except for that 5.5. Total them up. And then divide by 0.945 and tell me what you get.
679,108.
Matt got 679,108. I'll wait and see if y'all can have a consensus here. Sam says yes. It's okay. Let's talk about it. So the consensus in the room was, I think, 679,109. So let me show you why and how this works, okay? I'm going to show you the method so we're all on the same page. I said, in order to trick you into doing this, take every number you see in this equation. So we got 350, 1,800, and 289,958. And so in this kind of cheat method that I said, take every number you see that has nothing to do with commission. So we've got these three numbers, and I want you to add them all up. So you take $350,000 plus $1,800 plus $289,958. Now that gives us a total of $641,758. Now once you get that number, you divide by what is left over from 100% after you take our commission. Well, our commission was 5.5%, and so that means we are going to divide this by 0.945, which is $679,109. 108 or 109 if you rounded. Now let me show you how I just tricked you all into doing algebra if you do this. Now watch, and we're going to give you a couple examples. We're going to get everybody comfortable here. Folks, can we all agree that we don't know the purchase price, but we do know the commission's 5.5%. They want a net $350,000. They have a loan payoff of $289, and they have closing costs of $1,800. So here's what this looks like: 100% of the purchase price minus 5.5% of the purchase price minus $289,958 for the loan payoff minus $1,800 in closing costs needs to equal their desired $350,000 net. Well, there's the algebraic linear equation again. And so just start breaking it down. 100 minus 5.5 is 94.5% of P. Add 289,958 to this side. Add it to this side, 289,958. And that negates right here. Add 1,800 to this side. Add 1,800 to this side. That negates right here. And so if you add up every number you see on one side, total it out, and then divide by 94.5% on this side to just leave P, and divide by 94.5% on this side, or 0.945, purchase price equals, add up all those numbers that you see that are not commission, and then divide by the percentage of 100 that's left over after we take our commission. Everybody with me? So let's try another one, because we're going to make sure y'all are all comfortable. So example 2, we already totaled out, 679,109. Here's another one now. Let me help you out, okay? Seller needs $120,000 to pay off their mortgage, so that's a loan payoff. $1,000 for closing cost expenses, plus he would like to net $50,000 to use to purchase in his next home. If the listing firm charges a 5% listing fee, what is the minimum sales price that will meet these requirements? So let's just answer the first question. What is left over from 100% after we take our 5% commission? 95%. And so all you have to do, this plus this plus this, then hit equals. That's the biggest mistake people make, is they don't hit equals. So once you total that out, then divide by 0.95 and tell me what you got. So let's talk about this one, make sure we're comfortable. So just like before, and I'll give you the long kind of way of doing it, but then I'll kind of circle back around to the easy way. What we're saying is 100% of the purchase price minus 5% of the purchase price, which was our commission, minus the $120,000 loan payoff, minus the $1,000 in closing costs, needs to net the seller $50,000. And so add 1,000 on this side, add 1,000 on this side, negates, add 120,000 on this side, add 120,000 on this side. And so when you add the three numbers, like I said, the biggest thing is to always make sure that you hit equals, because that's what throws a lot of people off. You've got to have the whole number. So $50,000 plus 1,000 plus 120,000. So that'd be 171,000 on this side. So what that's saying is 100% minus 5%, 95% of P equals 171,000, or in other words, divide by 95% on this side to negate, and then divide by 95%, which is, remember, is 0.95 mathematically speaking. So the purchase price equals 171,000 divided by 0.95, 180,000. How are we feeling? Talk to me. I can explain it about 10 million different ways. Let's give one last one a try so we have a clean break as we wrap up this fun-filled day of learning. Okay, I got one more. Oops. So here is another one. And like I said, nothing crazy here. 85,000 plus 1,000 plus 65,000 hit equals. And then divide by 0.93. Nailed it. There you go. How are we feeling? Feeling better, everybody? Folks, y'all nailed it on this one. Folks, I just tricked you into doing algebra. Okay? It's not nearly as scary. Now, I want you to I'm going to tell you how this looks in the real world, folks. Imagine you're sitting at a listing appointment with a seller, and they tell you, well, hey, I need to net $70,000. You can do this at a listing appointment. Right? Because you take your discussion with your seller, like, okay, well, I need to net 70,000. You say, okay, well, 70,000, and you punch that in the calculator, and you say, well, what's your loan payoff? And they say, well, 148. Okay, well, you add in 148, and then knowing basic closing costs, deed prep is about 300. Add that in. Excise tax you'd have to calculate, and so depending on average sales price, you could say excise tax of like 800. And then maybe commissions. Well, commission's going to be last. And so let's say total expenses $219,100 on the scenario I gave you. If you know that you're charging them a 6% commission, divide it by 0.94. So, okay, well, based on your current criteria, we would have to sell it for at least, whatever, and add it all up. It's that simple. Add up all the closing costs, what they want to net, what it's going to cost, and then divide by whatever is left over. And so I hit a wrong button here. I wanted to net 70,000 plus loan payoff of 120,000 plus deed prep of 300 plus excise tax of 800. So 191,000 divided by 0.95. They would have to sell for 201,157 in order to net that. You can do this right then, right there. Now, this is not how we're pricing properties in the real world. We are looking at CMAs, and then we're doing net sheets. And so we're saying, if we sell it for this, if we sell it for this, if we sell it for this. And that's on the range of our CMA, low end to high end, and what are you going to walk away with? And then, we kind of give them some insight from there. But if they wanted to know what it was like to realistically try to net a certain number, you can do these basic calculations. Now, in the real world, folks, are you going to be doing these calculations a lot? No. You're going to be doing it the more traditional way with a net sheet. So this is a nice little clean break point. So we'll pick up with net sheets and CMAs again next week.